You guys, Shane's got this up on the screen, so this is kind of the topic for today, and this is something that we get quite a bit. And honestly, this is one of the ways that we want to be able to help people. Like you guys all know, being clients, that we're always about trying to figure out how we can save you money in taxes, how we can save you money in interest that normally would be lost to you, and kind of recover that. One of the things that people, when they're looking at like different retirement plans and everything, you've got accumulation phase, which is like, hey, we're cramming money into there and then we're planning on using it later on. And then you've got distribution phase. So that's what we're wanting to focus on today for the training, is having it be like focused on the distribution phase. Like, okay, how do we make that the most efficient? Because really, when you've earned all of this and you've saved all of this and you've amassed whatever you've amassed, now being able to, as my dad always says, come down the mountain safely is a crucial part. And so that's what we want to focus on today. So this is what?
Can't hear you.
Uh, Everybody was muted.
Oh, weird.
Oh,
Okay.
Sorry, including you. Sorry.
Oh, that's okay. So we want to be able to focus on like, okay, what's the most effective way to get down the mountain? And how do you know how much you can spend? And how do you know where it should come from? How do the policies actually help you to spend it better, to have it be more consistent, to have it be more stable? So there's a few different directions that we can go with this. And then also, how does that affect IRMA, which is like the Medicare part that, and you guys, and so I'll kind of start with that. So first of all, IRMA is basically where you have regular Medicare, but then you also have a surcharge where you're going to be charged more based on the income that you make.
Hmm.
So, and I should have looked up, I can do that quickly actually. But there's limits. I know that for like a single person, it's around like 106,000, I think. And they change that every year. And so the more that you make, the more that they're going to charge you for Medicare. And Medicare is not optional. It's like something that you're going to have to do when you turn 65 anyway. And then you've got regular Medicare, and then you've got the supplemental medical plans that you can add to that for like the part A, B, C, D, Q, whatever those different parts are. Anyway, so when you make more in earned income, the more that you make on that, the more you're charged on Medicare. And so you want to be able to keep an eye on that and understand that different incomes have different effects on your taxes, but it also can have an impact on your Medicare premiums. So just understanding that there's something to keep an eye on there. So in an ideal world, when you go to retire, then you've got, if you have deferred taxable income, which would be like a 401k, an IRA, 403b, 457, all of those different qualified plans where you basically chose to take a tax savings early on in order to pay the tax later on. Okay, so those are tax deferred accounts. So you get a tax benefit for early on contributions. It's usually something that you're doing through like an employer or through work, and you're contributing into it because we like the discount that we get on taxes. So on that note, when we have those discounts and then later on we haven't paid the taxes, now when we take out a disbursement, we're going to be taxed for it. So first and by the way, yeah, as you guys are muted, so if you guys have questions, then feel
There,
free. And
there
then
is a
Adam,
question
Shane.
here. Yeah,
Oh yeah.
Christy. So it says, does the limit change over time if income decreases?
Yes. And they go off of, and I believe that they go off of the last 2 years. So they'll take a look at like what has happened and then charge premiums based on that. So if you have an increase in an amount of income temporarily, then you're going to also have a temporary increase on Medicare premiums. If your income then goes down, then that's going to then readjust. So it doesn't go up and stay there. It's based off of your prior history right away. So yeah, good question. So one of the things that forgot what my train of thought was, and Shane and Adam, feel free to jump in on any of this too. By the way, my dad's out today. He's out with my mom, so enjoying the life. I wouldn't be surprised if he pops in on here just to make sure we're doing this right. But anyway,
Surprised he's not on here right
I
now.
know, I know. Yeah, he
Yeah.
usually has a hard time staying away,
He's
and he's at a
disguised as
convention with
somebody
my
else.
mom. Yeah, you know what? I mean, do we really know who Lee is? I mean, I think that might really be my dad. I'm just kidding, Lee. We know you.
Who's Lee?
Anyway, so, but when we're taking income in retirement, if we are not careful, we're doing tripwires tax-wise when we're taking money out. And so there was actually a couple that I talked to yesterday, and she has been taking out of her 401k really rapidly, and she was taking it out about $60,000 a year.
Oh,
I had the conversation with her and was looking at where her account balances are, and her account balances are about 800,000, and she was taking out 60,000 a year. So any problem that you see with that? Okay, when you're taking out, how do you know how fast or slow you can take it out? When you're
Rule of
taking out,
thumb, 4%.
okay, yep. So the rule of thumb is always like if you've got it in market accounts, then you can take out about 4% and have that last you for your lifetime. People are living longer, and also it depends on when you're retiring and how many years in retirement too, by the way. And so, and if you're wanting it to replace all of your income or part of your income. So in her case, she was like, well, she was about 66, I believe, if I'm remembering right. She was like, right, just like she retired. No, maybe she was 67. She had retired at 65, so she was 2 years into her retirement. She said that she met with a lady about an annuity, and she said the lady basically chewed her out and was so mad at her and said, "There's no way you can be spending that kind of money. It's not going to last you, and you need to switch that up." And she's like, she really like yelled at me on email, like with all capital letters, and was like really like mean to me about it.
Huh.
And then she said, "So what do you think?" And I said, "I am sorry, but I agree with her. Like, you are going to run out, like if you continue spending that way. So you need to first of all understand some of the rules of thumb. So if you're taking out of qualified plans or market accounts, whether it's mutual funds, regardless of how they're taxed, when you have market accounts, the rule of thumb has always been 4% and have that last you for a 30-year time frame. Now, in fairness to her, she said, "I don't plan on living into my 90s." And I said, "Well, what happens if you do? Then where is it going to come from? Like, where are you going to sustain your lifestyle from at that point?" And so she's like, "Well, that's a good point." And I said, "So you might want to just like slow it down and understand that if you're not wanting your kids to take care of you, then you might need to slow that down, because if you've got $1 million in a 401k, let's say 4% would be 40,000 for the year. Now you've got to factor in your tax bracket. Okay, you've got federal and you've got state for most people. Some states don't have state. And so if you don't have state, then it would just be federal, obviously. But you've got to take the taxes out. So if you've got taxes at say 20%, 40,000 is your gross amount. If it's tax deferred and has not been taxed yet, then what are you able to spend out of that? Okay, 20% off of 40,000 is 8,000. So 40,000 minus 8 is 32,000. Okay, so 32,000, which is 3.2% for every million. And then that's if you're wanting it to last you about a 30-year time frame. Now, that 4% rule, they're now saying that that's probably too high because people are living longer. And also you've got market volatility and some of those kinds of things. And so depending on how conservative you are with your portfolio in that, that might be too high. If you're like her, where she's like, "I don't plan on living into my 90s, and I'm pretty convinced that I'm not going to live into my 90s," then you might be okay. But you also need to have a game plan that what happens if you do live that long, then where are those funds going to come from at that point? Now, in her case, she has equity in her house, and so she has that as her kind of exit strategy, that if she needed to and had long-term care or she lived longer, then she has equity in her home that she could use that. And so that's kind of her backup plan. So if you have a backup plan, need to be looking at it and saying, okay, what would I do for long-term care needs? Like, where would that come from? And if I did live longer, where would that money come from? So you want to be able to spend it and enjoy retirement, but you also want to make sure that it's going to be there. So
so if I'm fine mooching off my kids, no problem, just disregard.
you know what? Then you're totally fine. That's your game plan, Lee. That's your
Love
exit strategy.
Love it.
Yep, exactly. Well, and that's the whole thing, is a lot of times we see people where this same lady, by the way, I don't mean to pick on her, but she's not on here, so I can, and I didn't say her name, so I can. So she said, "I gifted $150,000 to each of my kids in the last 5 years because I wanted to be able to help them to get a house." Okay, you guys understand that when you're taking out of a taxable place, I said, "Where did the funds come from when you did that?" You want to know her answer?
No.
You don't want to know her answer, but at least it's her and not you. But she took it out of her 401k.
Oh my gosh.
So
So
there's a
understanding
question
what
here,
that did
Christy.
tax wise. Yeah,
Is it smarter to use the equity first and let the nest egg grow?
good question. Okay, what are the pros and cons to that?
Will it grow?
Mm-hmm. So
The other con is that equity isn't liquid anymore. You can't use it for something else.
mhm.
If
Okay,
she
now
took
here's
the money out of her 401k, that instantly raised her income level. And that has effects down the line, including
Oh
a
yeah.
reduction in her Social Security payments.
exactly. So she raised her Medicare premium, by the way, which we were talking about a minute ago. She also raised her income tax bracket. And so the money that she took out, I told her, I said, you realize that in the tax bracket that you're in and the money that you were taking out, because she also has Social Security that she's taking and she has a pension. Okay. Now, Social Security, anybody know how much of it can be taxable? What percentage? Any guess?
But all the way up to, I don't know, I can think of all of it could be taxable.
Okay. Not all of it, but a
Like
good
80.
percentage. So up to 85% of your Social Security can potentially be taxable. Now, what determines if it's 0% taxable or 85% taxable or anything in between, by the way? It's not all or nothing. It's a grading scale. So what determines?
Your income?
Okay. Now, so income is a pretty big ball of wax. Okay. So what about 401k distribution? Does that count as income?
Yeah.
It does, because what did we do? We tax deferred it. So it hasn't been taxed yet. So it's going to come through the same way as if it was earned income.
But your Roth or your this one won't.
Now, if you had a Roth, then a Roth would not, because the Roth has already been taxed, and so it's not going to count against your income. So when you're taking income in retirement, where that income comes from makes a huge difference.
Yeah.
I mean, it can make a difference in the millions, you guys, not just a little bit of difference. So when we're trying to chase over, trying to save money on like, hey, let me hurry and pay my house off faster because I want to save $100,000 in interest, and then you're in the meantime ignoring the fact that you're going to pay out $2.6 million in taxes over the next 30 years, there's something wrong with that thinking. We need to be able to keep it in proper perspective and understand that there's a balancing act with all of this. And so the more planning that we can do, the more we can cut down on those taxes. Now, if you can take your tax bill over the next however many years and drop it down by $2 million, how much of an impact does that have on your lifestyle? Because you had that 2 million divided by 30 years that you had to spend, that you're not sharing with Uncle Sam. So that's the power of the policies and what you can do. The more you can cram into these policies, the better off you are. Now, some people would say, okay, but I can get a better rate of return if I leave it in my 401k than if I put it in my policy. Okay, which by the way, could be true, right? Can you get better return in a 401k than in a policy?
You're paying taxes
Again, is the rate of return against a steadily accruing compounded interest.
No, but they're also paying taxes on the gain, and then in your policy you don't. So that it just wipes out any gain that you got because you got to pay taxes on it anyway.
Mm-hmm.
And
Now,
then they have fees as well, right?
yeah, now I was going to say, so you've got the fees that go along with it, and then you've also got the taxes. So you want to look at what you're actually left to spend, because that's the only thing that actually matters. It's not how much money you accumulate, it's how much you can spend, right? And so the whole point of all of this is that we want you to spend more. And we also want you to not have to take as much risk. So my dad has a good rule of thumb that he says, if you have, 10% of your net worth that you leave at risk, then it's okay if that risk goes well and goes up and goes gangbusters, or if you lose it. And so being able to have that as your risk threshold, we see too many people when they're nearing retirement that they feel like I've got to make up for lost time, so therefore I'm going to take the most risk. Now, what usually ends up happening is that risk ends up paying off, but not in a way that they think. It ends up putting them backwards and not putting them ahead. Now, sometimes you have some things that are going to put you ahead and some things that are going to put you backward, and then hopefully you're overall moving in the right direction and moving forward, but there's no guarantees on any of that. So being able to stabilize your portfolio is also important. And so we're not saying that you should take every single dollar and put all of it into the policies, although quite honestly, that's my plan, but we're not saying that needs to be your plan. We're saying that you need to understand the tax ramifications of letting everything play well together so that you can let it balance out and help you with your taxes so that you keep more. Now, you guys have heard us reference this, but tax bracket management is something that we refer to, which is basically what we're going to kind of cover a little bit today, and understanding that, because when it comes time to retire, then being able to try to figure out, okay, when is it time to shift money from like a taxable source over into a policy? First of all, should you do it? And secondly, when should you do it and at what rate should you do it? So that's kind of the main discussion point for today, is figuring out how should that look and how do I know when I'm there. So first of all, when you look at the traditional realm and say, okay, if I'm trying to figure out, am I even close to nearing retirement? If you're looking at what your accounts are and then you use about 3.5%, then that's probably a little bit more realistic of a time frame to use and a percentage to use when it comes to your portfolio of things. So if you've got a 401k, again, I use $1 million just because it's easier math. So 3.5% would be 35,000 for every million that you have in a 401k. Now, you also want to factor in, okay, first of all, am I going to have Social Security, which the closer you are to taking Social Security, the more likely it is going to be there for you. Some people, when they're doing their retirement planning, they're saying, I don't want to plan on Social Security being there at all. And if that's the case, then you're going to need to save up more to make sure that you have enough that if Social Security is not there, or if it's half there, or whatever the case is, whatever Social Security looks like at your age when you get there, that you have a plan for that. So when you retire, you've got, okay, I'm getting close. And so if you're like, okay, well, what are my expenses right now? So there's two approaches, okay? One is to say, okay, income replacement. So if you're making $100,000 a year, how many millions would you need to have in the traditional realm in order to replace all of that income?
Mhm.
So a lot of times people are like, well, I don't know. Can I just start spending it because I'm 65 and I can just start spending it now, right? Doesn't really matter. I can just spend it at $60,000 a year like the lady yesterday. Okay, if you're wanting to make sure that it lasts you, you want to have some rules of thumb. You want to know when you're close, when you're there. Now, if it's in a policy, it spends differently. So money in a policy, if you're wanting it to last you about 30 years, so each of you that have your policies, look at what your cash value is. And if you take that number, first of all, that 3.5% rule that's out there for market accounts is not the same for policy stuff.
Mhm.
So the policy stuff, you can spend more and still have it last you longer. So if you take your cash value and you're wanting it to last you for 30 years, by the way, I wrote all these down, it's about 4.5%. Now, the money that you're taking out for income from the policy, how much of that is taxable?
The policy is zero.
None of it, right? That's why we do it, is to be able to give us tax-free income. So if you have $1 million in a policy in cash value, then you've got 4.5%. So that would be 45,000 a year. And then you can have it increase by 3% every year and have it last you for 30 years.
Mhm.
Okay, put that in perspective. So what does that tell you about what you're accumulating and trying to chase that rate of return versus what you're actually getting in spendable? So remember when I said $1 million in a 401k, if you're in a 20% tax bracket, then you're spending about 27,000 or 2.7% versus 4.5% in a policy.
That was invited to game night.
So when you have more income off of less there, then it means that you don't have to amass as much there, and you also have more safety and security with it. Now, can you play them off of each other? Absolutely. Okay, so for married couples, for example, the standard deduction is around 32,000 for this year. So if you are getting $32,000, let's say from a 401k, and then you had Social Security income and then income coming from the policy, what's your tax rate? 0. You see how it pays to be strategic? So in an ideal world, maybe what you want to do is take some of the 401k or tax deferred accounts and take it out and drip it out and then get it over into the policy that's going to make it more spendable, more safe, more secure, plus provide a death benefit, and then still have some of the 401k income give you maybe like $30,000 a year, because then you still are in effective 0% tax bracket, because if you have 30,000 coming from a 401k, and then you had 40,000, let's say, coming from a Social Security accounts, and then you've also got 40,000 coming from the policy. Okay, those three combined together, 40, 40, 40, you've got 120,000 coming in income. The only part of that that's taxable would be the 401k that was tax deferred. And so if that 40,000 coming in, and then you have a $32,000 deduction, that's the standard deduction, then you only have 8,000 of that that's potentially taxable. Anywhere from 0 to 10,000, is a 10% tax bracket. So our goal is to always get you guys in the lower tax brackets in retirement. If you can be in a 10 or 12% tax bracket or less, meaning that we want to have those 401k funds be able to provide some of that income so that you can have some of that upside that you might want to have. And if those accounts go well, then you have more to spend. And if the accounts don't go well, then you can have it where you take more out of the policy. You can let those two tools play off of each other. And so being able to have diversity isn't a bad thing to do. Same thing with real estate. If you've got real estate income and you've got Social Security income and you've got policy income, what is potentially taxable? The real estate income. Okay, so real estate income, you have taxes that are like it's more tax favored. You have some depreciation, hopefully. You've got some expenses that you can write off with that. And so anything that is a gain after those expenses are deducted, then that's your only taxable income. And so again, in an ideal world, if you're trying to pay no taxes, then you want to be able to have that income equal what the standard deduction is. If you're okay to pay a little bit of taxes and be in like a 10% tax bracket, then you can go over by 10,000, still be in that same 10% tax bracket. So is this helpful, you guys?
Yeah.
A lot of nods.
All right, let me pull this up too, because I think that you guys have seen me go through this before, but I think it's worth revisiting. Now, once you're 65, the standard deduction goes up, by the way. Let me share my screen here.
Stop sharing here, Christy, too.
Okay. So I just kind of threw in a number here, but if you're married filing jointly, and let's say that your income is 150,000, the standard deduction is 32,200. And so what's left is what you're actually taxed on. So that's what I was meaning before. So if you have income here that's 32,200 coming from a 401k or IRA, see how your taxable income is nothing?
Mm.
So that's what I was saying, is that in an ideal world, you want to be able to lessen your taxable income. Now, if you go up from here,
Christy. So
Yeah.
that is per, I guess, wherever you're getting the income from. It's not a combined thing. Is that correct?
So this would be if you're working, this would be earned income. If it
Okay.
was a tax deferred account, it would include the distribution from that tax deferred account, which is a good question, Curtis. I'm glad you asked that. Okay, what about like a brokerage account? How is that taxed? Like, so let's say you put into a brokerage account and you're investing in like mutual funds or stocks, and it's not in a qualified plan, it's just what we'd call a naked mutual fund or a naked account or an ETF account, EFT. Oh man, however that word is.
It's
So if
ETF.
it's in one of those, how are those taxed?
Capital gains.
Yeah.
Okay. So there's capital gains and then there's regular income, depending on how long you hold that stock or that mutual fund. I had a conversation with a lady earlier today about that exact thing. I said, she said, hey, I've got these accounts. She had like $6,000 in a mutual fund. And I said, just out of curiosity, how do you like that mutual fund? How do you like that bundle? And she goes, well, I actually don't like it because it's not really growing. And I said, how long have you had the funds in there? And she said, since 2022. And I was like, so in the last 4 years where we've had like good markets, it hasn't really grown. And I said, how much of that 6,000 that's there is from your contribution? Okay, you guys, if you have brokerage accounts, you need to look at that. You need to look at what your basis is, what your contribution is versus what the gain is. Because I don't care what they tell you the percentages are, you want to know how it's affecting your bottom line and your balance, not what they're taking out in fees. Because when they're giving the rates of return and it did this, by the time the fees and everything else come out of it, you want to know what you're left with. It's no different than when you're figuring it out for taxes. So on a brokerage account, the way that it's taxed is if you liquidate that account, if you put into a stock, you buy stock in Exxon, right? And then you liquidate that stock that same year that you invested, then it's short term, which is the same as ordinary income. Okay. If it's long term, if you hold that for a year or longer and then you liquidate it, it goes into a different bucket, which goes into a capital gain bucket, which is long-term capital gain. which usually is 15% for federal, and then your state might charge for it as well. In my state, it's 5%, which is pretty common unless you're in California and then they rake you over the coals. And I think it's like, who knows, it might be 15% at this point. But in California, they do a high rate on the capital gain tax. And so you want to know what those are. Now, whether it's a stock or a mutual fund or real estate, it's the same principle. So if you own real estate and you sell it within a year, then any of the gain that you have. So these people that are doing fix and flips, that's one thing that I did not have anyone explain that to me. And it was my own fault for not looking into it probably too. But when I got into real estate, I was doing flips and I was like, yay, I got 20%, my mythical 20% that I was always trying to chase. I got 20%, but then it's like, oh shoot, now I've got to pay tax on that because I sold it within a year of purchasing it. So now I've got a high amount of tax that I'm now sharing with Uncle Sam. So you want to just know what those taxes are. And if you can hold on to it for a year, then it might save you in taxes and then sell it, especially if you're close to a year. Now, it's not worth it if you're paying servicing fees on it and it's a real estate property. You're not wanting to pay 12% interest on it for 3 more months just to be able to save money on taxes. But you want to do the math and understand and run the numbers and see what that looks like. So long-term capital gains versus short-term. Short-term capital gain is the same as ordinary income. So whatever tax bracket you're in, that's where that comes into play. So if you're in a brokerage account, then they look at what your basis is. So if your basis was 100,000 and the gain is 200,000 and that was all in the long-term bucket because you held it for longer than a year, then it should be 15, 20, 25% depending on what your state and what the capital gain tax is. So you want to know what that difference is, but either way, it's still a high amount. So a lot of times people will say, okay, well, I'm not going to go into these 401ks because I'm not an idiot. I'm not going to do that. I'm going to go into brokerage accounts. Okay, well, brokerage accounts, you're either taxed along the way or you're taxed on the distribution or you're taxed both. And so you would need to understand that what you're actually netting, you need to be either taking out the taxes along the way if those taxes are coming out along the way, or you're having it come out at the end when you take that disbursement. Either way, it still is taxed. It's just a different ballgame. So you need to understand the difference in that so that when you're taking your income, then you know where that's coming from. What about an annuity? Anybody know about annuities?
Yeah.
Okay, so annuities, there's a lot of different kinds of annuities. So when people go to retire, you really kind of have a few different options, right? Okay, it's like, all right, if let's say I've accumulated my money and I've got $1 million, let's say in a 401k, I've got $1 million in a brokerage account, I've got $1 million in real estate portfolio, and I don't know, what's another one? Oh,
I don't have $1 million anywhere.
all right. Yeah. Well, and I use $1 million because it's easier math. Okay. And then I've got $1 million in my policy. Okay. Now, how do I want to spend that? Which one am I going to spend first, last? What's going to be my order? Okay. The first question you're going to ask yourself is, what's my risk tolerance and how much do I want to pay in taxes? Is it worth the trade-off to say, okay, I might potentially make more in my 401k, so I'm like, let that kind of keep growing and compounding. Or do I want to take the guarantee and switch it to something that's a little bit more conservative? Now, if you look at your overall portfolio, like in this case, I just kind of used the example of like 4 million total, right? Which I know is a high number, but I'm just using that number just because it's easier math. So if I've got 4 million in assets altogether, and I said that I've got $1 million in a policy, and then I've got real estate, I've got a 401k, and I've got a brokerage account. Okay, so of those 4, what are safe buckets and which ones are risk buckets? Okay, so we've got the market accounts, which would be the brokerage account, by the way, even though it's taxed differently, it's still a risk bucket. And then we've also got the 401k, those are 2 risk buckets. So we've got 50% in risk. Now, what about real estate? Real estate is tax advantaged. So what's the risk level on that? Pretty moderate, I would say. Okay, now you have some risk with, are they going to pay the rent? And I get that, and the market can go down, but for the most part, it's more moderate risk. And then you've got the policy, which is low risk. Okay, so being able to have a combination of those 4 isn't necessarily a bad way to go. But now what if I'm trying to take disbursements off of each of those? How are they going to be taxed, and how are they going to affect IRMA? How are they going to affect Social Security? How are they going to affect all of these other things? You want to be able to look at the chain reaction effect of the combination of those when you're talking about a portfolio. So usually when we get to retirement, we want to be more conservative with our portfolio. So what we see some people do is they'll say, okay, I'm going to take the 401k and I want to be more conservative because I can't afford to take that much risk. Maybe you take 80-ish% of the 401k and say, I'm going to move that over to an immediate annuity. And I
Yeah.
want that annuity to give me income. Okay. That annuity giving you income is basically kind of securing having that last you for either a period of time or for a lifetime. You can set up annuities any way that you want to. And there's deferred annuities and there's immediate annuities. So sometimes when we're talking with people, we'll advise them, and we've done this. We've got some clients on here where we've talked about moving some of that over into an annuity, because you're basically saying, I'm taking it out of the risk bucket and I'm putting it into a guaranteed bucket. But when we're doing that, we're also wanting to make sure that we know what everything else, other income sources are going to be doing for our taxes as well. So an annuity is a good way to be able to give you guaranteed income, to be able to take a lump sum amount, and you can take it from a tax deferred account. You can take it from the brokerage account. You can take it from any income source of where it already is and keep that same tax classification. So if it's in a 401k and you move it into an annuity that's going to now give you income, excuse me, income right away, it still keeps the same tax treatment. It still is tax deferred. And then now when you're taking the disbursements, you're taking it on a schedule that you set up. You can do quarterly, you can do monthly, you can do annually. And so you can decide how you want those payments to come to you. So sometimes people want to protect and say, okay, well, maybe I'm going to take some of that and have that give me guaranteed income. Now, in our case, if I was setting this up in an ideal tax benefit way, I would say, okay, let that income maybe give you 30,000 or 35,000 or 40,000, and then have that be going up. Now, why would I recommend that amount?
To keep the tax rate down and the
Okay.
IRMA expense down.
Mm-hmm.
Right.
Yep. So
That
again,
4%.
now I want to be able to, like, in an ideal world, I'd want to be able to, like, so if it was a married couple and both of you are over 65 when you're taking it, the standard deduction right now is 47,000. Now, what happens if the standard deduction isn't 47,000 and they make a change to the tax laws and they say, okay, now the standard deduction is only 35, then you're in trouble. So I usually would stay under that threshold for that reason, because right now they're a little bit higher than what they have been in the past, and you want to be able to account for that.
If it's part of the big beautiful bill, it'll be challenged. The standard deductions part of that big beautiful bill, someone's going to challenge it along the way.
Yeah, well, and it was actually part of Trump's first term. So he put the higher deduction into place then, and then
Right.
it was due to sunset, and then with him getting back in, then he was able to extend it. But again, when he's no longer president, who knows if that's going to revert back down. So we want to be able to account for that and not have that be something that we're planning on and then be like, oh shoot, darn it, now that's not going to work out. But there is going to be a standard deduction that's higher either way. Even under the old tax laws, these over 65 standard deductions are higher than the regular standard deduction. So if you know that that's going to be the case, then you can account for that a little bit, but you want to give yourself a little bit of a buffer. So now what about dripping out and taking out and putting it into a policy? Okay. How do you know how much your policy can handle? And is it a recommendation to ever start a new policy to handle 401k funds? And how would you do that?
I think so. I think that would
Yes,
be good.
yes.
Okay. All right. So here's the deal. So each of you guys with your policies right now, if you're in your accumulation phase and not in retirement phase, then usually you're putting aside a percentage of your income that you're putting into the policy. Okay. If you're a 20-year-old, it's probably 10%. If you're in your 30s, it's maybe 15%. And depending on how much you've accumulated, the recommended retirement savings is anywhere from 10 to 30% of your gross income is how much you should be putting aside. If you're in your 50s and you have no retirement savings, yeah, you better be putting aside 30% of your income, or you're never replacing your income because you don't have enough time for those funds to be able to compound. You guys, the policies make up for a lot of lost time, but they still can only do so much. We had somebody recently who was like, I'm 68 and I need it to replace $73,000 within 3 years, and I want to start now, and I have $3,000 a month that I could put into it. And I'm like, sorry, but I'm not even going to try to touch that, because I don't want to set up an unrealistic expectation that's just not even there. There's nothing that is going to give you that, by the way, but I don't want to like take the liability. Like, she terrified me, and I told her she's not a fit. So because I feel like, anyway, you need to understand what's realistic.
Her
So
expectation's too high.
now, if you were putting that in a taxable environment, you'd probably need to do 35 or 40% of your income. So you do need less of your income by putting it into the policies, because we're not having to leak out to taxes later on. And because of the death benefit, you're able to spend more. I mean, it can provide some miracles, but it still needs time to be able to compound. It still needs to be able to grow. It still needs to be able to have a minimum of about 5 to 7 years before it's going to make sense to have it be something that's viable to provide income for somebody. So
Thank you. You said too. You said too. It would make sense that to start a new income if you got a windfall.
Okay, so that's exactly where I was going with that.
Oh,
so
okay.
if you're putting money aside, so let's say your income was 100,000, and for most people, the savings is going to be between 15 and 25%. So I'll kind of use 20% in there. So if your income is 100,000 and you're putting $20,000 a year into your policy, okay, now you're like, you know what? I think I have enough to kind of retire. I'm getting close to, and again, use the 4.5% on your policy cash value and say, okay, if I wanted this to last me 30 years, that will give you an idea of what kind of income that would generate for you right now. Okay. Now, if you're like, okay, well, what about if I'm in my 70s now and I don't need income for 30 years, I need it for 25 years or 20 years. Okay, you can increase that by about 0.5% for every 5 years. Okay, so depending on how long you need or want that money to last you, then you can kind of do the math that way and kind of be in the ballpark. Now we can run this with you and do in-force illustrations to tell you guys exactly. So if you're getting close to retirement, this is where we want to tweak it and fine tune it, but just know that that will get you in the ballpark. Okay, now on those other accounts like 401ks or brokerage accounts, you would want to use the 3.5% and then take into consideration what your specific tax bracket is. For some people on here, your tax bracket is 43% and you're in the highest tax bracket. For some people, your tax bracket is 10%. So it's going to vary, which is why they call this a rich man's Roth, because the more that you make, the more valuable these policies are, because you're not losing 43% to taxes. You're losing nothing to taxes by putting it into the policy. So the more you make, the more valuable these become. Now, having said that, it's still valuable for somebody even in a 10% tax bracket because of what it's giving you versus what you're putting into it. But I'm just saying, from a tax savings perspective, you have a lot more that you're saving in taxes the higher your income is. Okay. Now, on dripping out, when you're taking out and you're going, okay, well, let's say I have a windfall, or let's say I have a 401k that I want to move part of it over into my policy. When do I do that and how do I do that? Okay, now your existing policy in this example can only hold $20,000 a year. Okay, now you retire. Okay, now you don't have the 20% that you're putting aside because now you've retired. Okay, at that point, what we're going to do is we're going to say, okay, what's your current tax bracket? So in this case, I said that the person was making $100,000 a year. Okay, so what's their tax bracket right now when they were making their money? 12%. Okay, now let's say that they're retired because they've amassed their funds, and now they're saying, okay, I can only put $20,000 a year into my current policy, but I'm no longer working. So where should I have that income come from?
I don't know.
Okay, so we're going to start with the biggest tax problem, which is tax deferred. Okay, so that's going to be the first place that you're taking out of. Okay. Now, if you were making $100,000 a year, then how much would you take out of your 401k to give you your same lifestyle that you were making before you quit your job? Okay, same 100,000, right? Okay, now when you're taking out 100,000 out of a 401k, isn't that going to keep your same lifestyle what it was?
Yes.
Okay, which part of that lifestyle was putting 20% aside into the policy. So are you going to still continue putting the 20% aside into the policy with that circumstance?
I don't think so.
Why wouldn't you?
I would.
Okay.
Yeah, you should.
You would want to. So this is what we mean by tax bracket management.
Okay.
Now here's the other part to that. So in this scenario, the person made 100,000 and then the standard deduction is 32. See down here where it says headroom until the next bracket and it says 33,000.
Okay.
Okay, now what that means is if we want to stay in a 12% tax bracket that we're already used to being in, we can also take out 33,000 in addition to what we're used to having it for our lifestyle, and we can still stay in a 12% tax bracket. Now, if our existing policy can only hold 20,000, then what would we do with the other 33 if we took it out?
Start a new policy.
Okay, exactly. That's where we would drip it out and start a new policy. We always want to fill up the first policy first, which was that 20,000. And so a lot of this is going to depend on the tax bracket that you're in Now, sometimes, let's say that this person is still working and they're going, well, wait, I'm over 59 and a half, but would it make sense for me to start dripping out of my 401k now? What do you think?
Absolutely.
Okay. This tells us our threshold. So if we can still stay in our same tax bracket and get it out, now I don't ever want to maximize this. So instead of 33, I would probably recommend the person to maybe do like 25, just in case they have some other income or something that they forgot about, or they get an extra bonus. I don't ever want to put them in the next tax bracket. But I would say, okay, right now you're still working, you're putting aside your 20%, your 20,000 into the policy. Maybe it's time to start another policy and start dripping out of the 401k while you're still working, and take it out at $25,000 a year and start a new policy with that that's going to give its own set of income to us when we retire. So that's a circumstance where we would want to do it early. Now, what if somebody's at the tip top of their tax bracket already? What if this person already has 133,000 in income? Sorry, let me go below that, 131. Okay, what if this is their case? Would we want to drip out of a 401k while they're still working?
It doesn't look like there's much headroom, so I would say no.
No, we wouldn't.
Well, the next figure is 211, right? 211.4.
So right now they're in a 12% tax bracket, and if they took out more because they took it out of the 401k, that's going to jump them from a 12% tax bracket to a 22% tax bracket.
Oh yeah, okay. I'm not looking at the standard deduction. I get it.
Now,
Yeah.
and by the way, whether this is standard or itemizing, it's the same kind of thing. It's just going to give you different numbers. I mean, if you were itemizing and if you're itemizing, it's because your itemized deductions are more than the standard of 32. So then that might give you a little bit more headroom that year if you are itemizing, by the way. So that's something that you want to consider. But just
They both
know,
get you to an adjusted gross income.
yeah. Well, either way, it takes you to your taxable income. So if you take your income, minus out your either itemized deductions or standard deductions, what you're left with is your taxable income, and that's where your marginal tax bracket is. Okay. Now, I know I've said this before, but the effective tax bracket, or the effective tax rate, this 11.5, this represents the tax bill in relation to your actual income. And so that's what that number is. So if this person took out an extra 30,000 and took this to 61.
Uh-oh, there we go.
Okay, now there's two things to consider. Number one, the effective tax rate went from 11 something to 13 something. But how much were they actually charged on that extra that they took out? Anything that was in that 22% tax bracket, which was all from the 401k, was taxed at 22%. Okay, it wasn't taxed at 13%, even though our effective rate is this. So anything that you go over, either that you earn over or take out and withdraw over your bracket, is going to be taxed at that higher rate, the full amount. So 22% is taxed. So if you take out 10,000 from a 401k, you want to do the dollar math, not just the percentage math, and say, okay, for every 10,000 that I take out, if I'm in a 22% tax bracket now that it jumped me to, then 2,200 of what I just took out just went to the IRS. And that's on the federal side, not state side, which you might have a state side as well, depending on how your state treats that. So keep in mind that we don't want to trigger and go over into the next tax bracket if we can avoid it. So that's what we mean by managing the tax bracket. So if your current income allows for some headroom to start dripping out of a 401k while you're still working, then that's okay. Now, what about if you're in like a high tax bracket, like 32, 35, 37? Then are we wanting to drip out in addition when you're already there and you're already high? Probably not. We're probably going to wait until you're not working anymore and then have the income be provided and have the excess be what goes into the next bucket for the policy.
Christy, I have a quick question about like when you're working and what you're allowed to contribute. So I have a Roth, and am I correct to think that as soon as I stop working, I can no longer contribute to that, right?
Probably, yeah.
So then
There's
that
also
would be
income thresholds with Roth. So sometimes
right.
If you make too much, yeah.
Right. So I mean, I'm trying to maximize with the exception of this year with all the expensive, like maximize that contribution. But the second I stop, I don't think I'm allowed to contribute it. So then that might be a good time to start a new policy with that one. But then the other question I had, part two of this question is, because you said you're going to take money and drip it into another account. Do you is there a way that you can just like now, because I'm older, so if there's a way that I put that kind of money into the thing and into a policy that I can start taking distributions sooner than the 7 years or
You don't
not?
have to wait until the 7th year to take distributions. We have some people who will start a policy and take a distribution on the policy for income the exact same year that they start it. You need to wait 30 days. So if you don't need the income, then you want your
To
income
grow, you want it
the
to grow.
policy to be last, because we want to take the tax band-aid and rip it off first. But it also might be something where, like, if this person was, like, it might be that you have some of this income coming out of like a brokerage account where it's taxed at, like, some of it's taxed, some of it's not, because you have your basis. So you can kind of straddle that depending on what the assets are that the person has. Then we would kind of there's not a one size fits all. In other words, it just depends on what your situation is. But if you think about what you're getting with a Roth, so continuing to contribute into a Roth, even if you could, would probably not make sense. So even if you were able to, I wouldn't. It would still make more sense to put that over into the policy, because the policy gives you more guarantees and it's going to give you more income, and then you don't have to worry about the risk. And it's the same tax treatment as a Roth. In other words, you've already been taxed on the dollars before it goes in, and then it's tax free. It's the same way with the policy. So even if you could, I wouldn't. But unless you just really like the markets and you're, feel like
No, I don't love it.
well for you, then that would be a good place to put it. So if you like markets, then the Roth is the way to go. People ask that a lot about a Roth conversion. They're like, okay, well, I was planning on doing a Roth conversion. Now, what's a Roth conversion? Now, if you're working and then you do a Roth conversion while you're working, then you're adding to your taxable income the amount that they just took out of the traditional 401k or qualified plan and moved to the Roth. You're taxed on that now, and then there's a 5-year look back. So you can't really spend it or use that account for 5 years. So you want to be very careful with Roth conversions. Quite honestly, most people see more benefit by, instead of doing a Roth conversion, doing what we're talking about with this, which is basically like a policy conversion, converting it from a taxable account and moving it over into the policy, because the policy is going to give you more income anyway.
But you're not limited, like, for the catch-up amount for people over 55, I think is 8,600. You're not limited to that with this.
Right. The policy doesn't have a limit like the Roth does, or the traditional qualified plans would have.
All right, let's get out of my mess that I'm in now. We'll talk about that next year.
Sounds good. All right. Any questions on that, you guys? Hopefully that's clear. We've got about 5 minutes left, and I know that there's messages here on the chat. But that's probably the biggest question that we get is, okay, how do I know, first of all, when I have enough to retire? And so if you use those rules of thumb, that kind of gets you in the ballpark. Now, here's another thing to consider. Sometimes it makes sense to also have home equity that can be utilized, which would be like either through a first position mortgage or even with a reverse mortgage, to have that provide you additional income. Sometimes being able to have a first position mortgage or a reverse mortgage that you have in your toolbox is also beneficial, because what if you're wanting to get it out of there, but yet you don't have the ability to get it out safely yet? It might be something where you temporarily borrow it from your HELOC or from your reverse mortgage and then take it back out safely from the 401k next year or for the next 3 or 4 years. Does that make sense? It kind of gives you permission as long as you have a game plan. So you want to be strategic no matter what, and understand what the consequences are, what's the tax benefit, what's the tax effect, and do it in dollars, and it helps you to be able to weigh it out, so that if you're like, okay, is it worth it for me to take it out this year? Ask yourself what you're going to lose in taxes. And if it's 32%, then it's like, okay, if I take out $10,000 and I'm going to lose 32%, $3,200, is that worth that trade-off? Where am I going to put that? What am I going to use it for? It helps to do the math easier when you look at the dollars and not the percentages. And so when it comes to retirement, you're going to be doing the same thing. And it makes an absolute difference on how you spend it. Which assets should be spent first? And do you want to do a combination of the assets? Do you want to have some risk, some reward? Do you want all of it safe? So know that there's multiple different ways to do that. An annuity is another one. We like the policies first and foremost because we like tax-free. We like the tax benefits of it. The next best friend, as far as I'm concerned, as far as guarantee and sustainability, would be an annuity, whether it was for a set time frame or for your lifetime, because you can set it up to where it goes up with inflation. You can have it go up by 1 or 2 or 3% or however 5% if you want to. You can have it increase and it can give you some guarantees, but that is going to be taxable depending on where it came out of. All right, we've got the poll up here. This helps us to kind of know what to cover next time. I'll stop sharing, and any questions that you guys have. Was there anything, Adam or Shane, on the comments on here that we need to cover?
One thing I would say, and I'm thankful Christy has all this knowledge because it's a lot more than I have.
No.
But,
Learn
in
part of it.
regards to like being in that retirement phase of life, most people want to keep it simple, They just want to have money coming in. They don't want to have to go back and forth and like do all these calculations. At least I don't personally. So my personal solution is to just get as much dang money into the policies I have now as possible. So I don't really have to worry about a lot of this stuff,
Sounds like a good plan to me.
Yeah.
Yeah, eliminate the risk, right?
Yeah.
Yeah. Well, and a lot of times too, like people, like there was a guy that I talked to yesterday, and he didn't have any retirement savings, and he's 57, and he's like, I'm very behind. And I'm like, well, here's the deal. You can catch up, and and you can do it without taking risk. And I think that's the biggest message, is that you don't have to take risk unless you just want to.
Yeah.
So if you like the risk, then feel free to take it. If you don't like risk, there's another way to do it. And so being able to mix and match your personality and your benefits and everything else helps you to be able to do that. But even if you are taking the risk, then you still want to still plan on about 3.5% that you're taking out of even that risk account. And so, as it grows, being able to then decide if you want to shift it over into your policy and when to do that allows you to sometimes take advantage of the growth there that's hopefully there, and then also shift it into a tax-free environment that is able to then give you stability without taking the risk. And most people in retirement, they don't want risk. And so if you look at your overall portfolio, when you're in your accumulation phase, you can afford to take some risk. When you get to retirement phase, you need to preserve what you've made and not take the risk. And so you want to minimize that as much as possible. Does that mean you need to take 100% of your portfolio and move it over into the policy? No, but it means that you need to know your thresholds. It means that you need to know what your spending habits are. You need to know what your upper limits are and not go above that. And if those accounts grow better than that and you're taking out the 3.5%, then you can kind of give yourself permission to take out a little bit more than that later on, but not be planning on it being 7 and 8% that you're taking out and then hoping it sustains itself, because it's not likely to. And then you're going to find yourself holding the bag later going, okay, well now I'm going to have to move in with my kids, and I wanted to be able to leave money to them, not have them take care of me. So that's the whole point of the conversation, is to understand that being able to be conservative with your withdrawals, regardless of where it's coming from, helps you to make sure that you have enough to last you too.
Christy, you had said something in here about having annuity as possible part of that toolkit, but I seem to think I remember you saying that you don't not like annuities, but what you don't like about annuities is that you're locked in, that you can't change the term. So what you have to really know that that's the way you want to go before you do an annuity. Is that right?
That, and I would only do it with a small portion of it. So if it was like, okay, I need $100,000 to live off of, like on the case where I said that somebody has $100,000 that they were needing for their lifestyle, and that's what they were used to before they quit working, then in that case, I would say maybe take maybe 20% or less and have that maybe come from the annuity.
So why wouldn't you just put it all in a policy in one place instead of doing and breaking it up in that way? Is it because you can't put so much in a policy, you need to split them up so you don't mess? Or why?
No, it's more just because sometimes it allows you to be able to have some that's steady and consistent, and that you just kind of know that you can plan on it, and it's just a guaranteed amount.
But if you pass on when the annuity is going on, then the balance, where does that go?
You can have it set up to where it actually goes to your beneficiaries.
Okay.
Like you can have guarantees built into it. And again, I'm not necessarily a fan of, if I had my choice over a policy versus an annuity, I would take the policy all day. Some people need structured payments, and so sometimes that annuity helps to give you structured payments versus having the temptation to spend it too fast. Like the lady I mentioned yesterday, where she was spending $60,000 a year. Like there was no governor on it. So sometimes having an annuity helps to give you a governor. And sometimes people need that and sometimes people don't. So that's why I'm saying kind of know your personality and your
Oh,
style.
I
and know
see. I
whatever
didn't
you
get
are.
that. I didn't get that nuance and while I was doing text from work, but yeah, I understand now better.
Yep. So that's the point with that. So yeah, in her case, I mean, I think that if that was in an annuity, it would keep her from overspending because it would allow her to know what her budget was, and then she would still have some that was left like in the policy that she could kind of just spend at her discretion, and then when it's gone, it's gone. Versus her thinking that the markets are going to just continue
Like,
to.
woohoo! I got some money. Let's go buy a jet ski.
In her mind, she thinks, oh, my accounts are going to do 24% every year, so I can't spend it fast enough. And I'm like, yes, you can, and you are spending it too fast. So there's that. That's what I mean by that. Like sometimes
Okay.
people need a governor. So,
Okay, I get it.
yep.